lockdown and not much of a capacity for the fisc to support. In fact, it is the banks who are expected to support the economy. Well, with that observation now, Bank Nifty still down 1.2%. Let's invite our market master for the morning, Saurabh Mukherjea, founder of Marcellus Investment Managers, joins us. Good morning, Saurabh. If the market was depending on some kind of a fiscal push, should it start giving up that hope?
I think the fiscal push is broadly along the expected lines. The par for the course in our country, as you would have seen for several decades, is get the PSU banks to lend some money, announce some tax stops. What was more interesting, I thought, in the PM speech a couple of days ago was the mention of bold economic reform around labor, around land, liquidity, and so on, and a pretty explicit hint that we will try to bring global supply chains around medical devices, around pharmaceuticals, APIs, and I presume also around defense equipment and so on. You can't be really self-reliant if you're the world's second largest importer of defense equipment. So that piece, I think we're waiting for the follow-through on that. I think that's the more exciting piece. Beyond that, this is what we're seeing is sensible stuff, fiscally sensible. Par for the course Indian relief measures. They will have a bearing. I thought of the 2 days of FM's announcements, close to $4 trillion credit guarantees that the government is offering to MSMEs with the more aggressive definition of M that we are seeing now. I think that was probably the most salient stuff. But I think the really exciting stuff lies ahead around can we really attract investments in electronics, in defense equipment, in medical devices through a combination presumably of cheap land and tax breaks for the global majors. That's what I think that'll be the game changer. If that doesn't come, I think we carry on fighting our way through the crisis. That being said, I think the lockdown unwinding the world over, the data that's coming through from a range of countries suggests demand recovers pretty quickly after the lockdown unwinding. So I was listening to you talk about the labor moving back to the villages. My reading is over the next 3-4 months, our bigger challenges will be supply side labor shortages rather than demand deficiency. I reckon demand will recover, perhaps not entirely to say January levels, but pretty close to that. Our bigger challenge, I think, for the rest of this calendar year looks likely to be on the labor side.
Saurabh, good morning. So in that case, that would impact some of your portfolio stocks as well, right? I mean, a lot of companies where you've been talking about the demand being strong, but at the end of the day, if it's going to impact the supply chain, it will impact the earnings. So is there any kind of portfolio changes that you would make in current times, or would you stick to the kind of stocks that you have?
I think, Anuj, where the labor supply shortage will hit smaller companies far more, right? If you take, say, the sorts of companies we invest in, a Pidilite or an Asian Paints, or indeed an HDFC Bank or a Kotak, these are more capital intensive, relatively labor light companies. It's unlikely that Asian Paints' labor force has migrated back to the villages in northern and eastern India. But for the SME sector, the labor looks likely to have migrated from, say, Chakan, from Hosur, and from, say, Manesar. And the irony is the government's relief package is probably going to make the labor even less likely to return to the cities, right? So we're probably looking at a good year in which the medium SME sector, remember, I think something like 90% of Indian companies have less than 10 employees. Those sorts of companies, I think, will struggle with labor shortages, and I think there's a good chance that for those companies with less than 10 employees, which is the vast majority of our labor force, they might have to offer significantly better wages to draw the labor back, which in turn potentially generates some demand for FMCG, but also has all sorts of other consequences around inflation that are not fully understood at this stage. For our own portfolio, actually, we are pretty comfortable. We can see what's playing out. We can see that getting logistics moving in this environment is difficult, and therefore naturally, say, an ITC or an Asian Paints is much more likely to be able to get logistics moving. As we just discussed, labor shortages are going to be an endemic issue, I think. Again, the larger companies are better off there. I really fear for the smaller companies and their labor availability for the rest of this year.
Saurabh, good morning indeed. I mean, when you see these scenes of migrants leaving cities, urban centers, you wonder if urban centers like Delhi and Bombay ever gave them their due in the first place. But I want to take forward the point that you made on consumer stocks, because you track that space so closely and are invested there. the market has had an interesting reaction. I mean, for instance, Nestle's numbers were nothing to complain about, but the market suddenly was taking note of valuations. So how do you think people will dissect staple stocks from here? The demand is very much there, but some of the supply and labor constraints perhaps need to be kept in mind?
I think, Surbhi, in all fairness to everybody out there in India and even in the West, I think there's so much fear at the moment. People have been sitting in their houses for 3 months, constantly reading this, barrage of bad news around deaths and so on. But I think rational reactions will be some time coming. I think it'll take time for people to live with COVID, understand that normal life will go on. We'll all have to get back to work in a normal shape and form with our masks and our, 2 gaj duri and so on. What I think is more interesting to focus on is how post-lockdown demand is normalizing. I think several global companies are doing presentations for investors around the world as to how quickly after lockdown Chinese demand recovered for washing machine, fridges, cars, motorbikes. You guys were just discussing the Chinese industrial production numbers. I look at industrial pollution levels in Chinese cities. You can do that easily on the internet. Industrial pollution levels in Chinese cities is back to December levels, right? You can get data, it's easily available, that Chinese traffic levels is back to November, December levels, and as a result, oil demand, which was expected to drop sharply, hasn't dropped around the world as much as supply has dropped. So ironically, supply of oil has dropped far more than demand for oil has dropped. So I think this piece, right, as we come out through, say, June, July, August, and indeed as the rest of the country potentially comes out of the lockdown gradually over the course of May, I think the normalization of demand will be the main driver of sentiment. I'm not so sure I'm going to lose that much sleep about, people worrying about Nestle or Asian Paints' PE multiples. That's neither here nor there. I think the next 10 weeks of demand normalization will be critical for driving sentiment in the stock market.
Okay, while you said that, Saurabh, most of your stocks, like for instance Asian Paints or the 2 banks, HDFC and Kotak, are all not impacted by a post-COVID lifestyle change. Are there any stocks, say stocks like PVR, which we were discussing earlier, any set of stocks that could get impacted, and these were marquee stocks?
So I think there are 2 sectors which look to me to be positively impacted, and we can also discuss a couple of sectors which do look to be really facing an uphill battle. So again, data from across the world is suggesting that small car and bike demand, motor, 2-wheeler and bike demand picks up post-lockdown because people are going to get back to work. Workers have to return to their factories, but they're reluctant to use public transport. So there's plenty of now data coming through, both in oil demand and in auto demand, that it picks up relatively quickly post-lockdown ending because of the need for personal transport as opposed to public transport. So the auto sector, I reckon, both from a domestic demand perspective and from that global supply chain point of view that the Prime Minister was highlighting, I think there's potential upside there on both fronts. So 2-wheelers more than perhaps trucks, and 2-wheelers and small cars more than perhaps the general sort of the higher end of the auto space. I think the second is pharma, right? So we are investors in Divi's Lab. We follow the API demand story quite closely. It is relatively clear that India will get a bigger slice of the global API supply. Some of it will move from China to India because the big 6 Western pharma companies will buy more from India. If they buy more API from India, even the chemical intermediates will benefit from that. Now, whether the government will announce something special on the API front, I don't know. But even without that, I think there's a positive story to be told on the active pharmaceutical ingredient side. The challenges obviously are public entertainment, so restaurants and cinema halls.
Sure.
It's going to be a long haul there in terms of the life back to recovery.
Fair point. Thank you very much, Saurabh Mukherjea, for joining us this morning with your thoughts on how portfolios may be impacted and the impact on the economy itself. Well, we are going to discuss the impact on the economy and stocks yet again with